What is up, YouTube fam? How you guys doing? It's always great to see you. Now, I've had numerous requests for the topic we're going to be covering today, and that is, Mike, what real estate investment trusts do you own? Now, I've made about 1 or 2 videos on REITs now on the channel, which I'll link them below if you haven't checked them out. Make sure you do, because that explains in detail what a REIT is and kind of how it stacks up against other investments. Don't worry about taking notes. I have a lot of information here, but you don't have to memorize anything today. You don't have to take notes. The spreadsheet you're going to be seeing on screen throughout the video, it's free to download, and so you can just download it. I'll leave the Dropbox link in the comment section and in the description section of the video for you to check out. In this video, I want to cover what 7 REITs I currently own, what kind of properties they hold, the kind of investment returns they've received over the last 5 years or so, the kind of dividends they provide, and so on and so forth. And I've included in this spreadsheet several different tabs that will give you more detailed information on each one, which we're going to be covering throughout this video. If you want to support the channel and the work I do here, you can do so simply by dropping a like, leave a comment below, and consider sharing this information with others. And that will greatly help this information reach more and more people over YouTube. And I always appreciate your support, guys. And I appreciate you being here because I know it takes time out of your day to watch these videos. Let's just start with DLR, which is the Digital Realty Trust. And if you're this investment, this REIT holds data centers and has a lot to do with cloud computing. And when I learned about this investment, I was particularly excited because if I were to ask you guys, do you think the world's going to become more and more cloud-based, computing-based, or less? Well, I think it's going to become more if you were to ask me. I'm going to be jumping in between the summary page and each tab that goes into more detail on each investment. So that's kind of how I'm going to present this. So what's Digital Realty Trust about? It says Digital Realty owns, acquires, develops, and operates data centers. The company is focused on providing data center co-location and interconnection solutions for domestic and international customers across a variety of industry verticals ranging from cloud and information technology services, communications and social networking to financial services, manufacturing, energy, healthcare, and consumer products. Oh my goodness, that is a mouthful. Okay, but what you really need to know, or if you don't need to understand all of this. You really don't. I mean, you just have a general sense is that they own real estate that houses cloud servers or data centers. That's what they do. They own real estate where people and companies can rent from them to house their cloud computing servers and all that to help them run their business. They have had consecutive dividend increases for the past 14 years. They're about $38 billion in value. They're the 9th largest publicly traded REIT on the market and 13% CAGR, which I honestly don't know what that means without looking that up. But the lease 5.3 is the year's average remaining lease term. So they're saying there that their customers, they have longer lease periods with, the customers they're working with, the properties they're holding have longer lease terms or lease periods. So they're pretty stable and pretty secure. And just so you guys know, the information for this video is coming from Yahoo Finance, and I've went to each individual company's website for each real estate investment trust. One thing I want to always look for, is I want to see that their gross profit is growing every year if it can. It doesn't have to, but it really is good for me to see that if they're growing their top line revenue, their gross profit is their top line revenue, they're growing it every year, in which this company is. All the way back from 15 to 18, it's grown pretty substantially. The next thing I come down to when I'm looking at the financials is net income. How is this company performing? And so I like to see net growth in net income, and this company has done that. And they've continued to make money every year. They're not increasing their net income every year in this case, but at least I know they're making money every year, and it looks like they started to turn things around here in the last 2 years, and maybe eventually they'll surpass what they did in 2016. I've included the cash flow information, and one of the primary things I learned in accounting when going to school to become an accountant was look at the cash flow from operations, because what that basically says is if you look at the total cash flow from operations, it's saying that this company is able to, by them being in business and just doing their business, they're bringing in more and more and more cash. Well, to me, that sounds like it's a successful business. And so this company has been doing that. Every year, their cash from operations continues to increase and grow, which is exactly what I want to see. A quick overview of the graph of the chart of DLR over the long run. Now, this has been in existence probably since 2004. It's had a pretty good run. as you can see. The graph is pretty solid upward trend and continues to do so, with some volatility, of course, in between. So the way I've designed this spreadsheet is the price per share, and this is all the data is as of September 6th of 2019. So the price per share of Digital Realty Trust is about $128. Dividends per share is that, $4.32. Yield is about 3.41%. They pay out on a quarterly basis. Up here I have the performance tab, and this gives information on their average returns. Okay, this is on average over this time span. This is what you as an investor could have expected to receive from each of these real estate investment trusts. So about 18% per year rate of return. Over the last 2 years, though, it's really dropped to only about 3%. So those last 2 years haven't been so good. But this year, in 2019, it's been doing very well. In fact, many REITs in 2019 are doing so well. They're one of the best investments of 2019. 21% year-to-date return in 2019 alone. But these are just averages, okay? So just keep that in mind. And you should always know, and I've said this in many of my other videos, is past performance never does guarantee the same results in the future. So these results could obviously change, and they will, but hopefully if it's a good company, they continue to bring in more revenue every month, they grow their operations, they grow the amount of real estate holdings they have, their customer base, then they're going to keep increasing their bottom line, then they're probably going to do well in the long run, right? Their performance is probably going to remain fairly consistent. I'm not going to go to each of these websites, but you can do that when you guys download the spreadsheet for yourself. The links to every single one of these companies' websites can be found right here. All right, now let's look at EPR. Now, EPR is one of my favorite REITs in my portfolio, and this was actually the first REIT I ever bought. You know, when I was looking back when I picked these things, you know, I wasn't some genius stock picker, and I'm still not some genius stock picker, right? I'm not. But EPR was the first one I chose because when I looked into it, when I looked in to see what they were about, let me go to the tab here, it made sense to me. The investment made sense. Just from a big picture perspective, I liked what I was seeing. Now, EPR is all about entertainment properties, properties that are held for recreational purposes. And so they own things like movie theaters. They own things like ski resorts. They even own education facilities, which I'm not sure which ones they own, but I know a lot of them are private and charter schools is the buildings they own. So entertainment, recreation, and education. Those are the three primary real estate holdings they have. As you guys can see, this REIT has done quite well over the lifetime of its performance, and you're going to see that from the graph here in just a second. But this is a portfolio detail. I found this on their company website. They have megaplex theaters. They have entertainment retail centers. They even have, see where it says golf entertainment? Yeah, that's Top Golf. They own Top Golf, which I've been to Top Golf. Every time I go to Top Golf, I don't know if you've ever been, but the place is packed out. It is for 4 floors of people lined to the brim. I mean, it is completely packed out all the time. I've never seen it not busy. And these are the kinds of properties this company holds. And so that's just a global snapshot of the kind of, you know, real estate holdings they have in their portfolio. How's their net income? They've been able to grow their top line revenue every year since 2015. If you go down to net income, the same thing is happening. So since 2015, their net income has grown every single year. So I like that. How's their cash flow from operations? Look at their cash flow from operations here, right here. Here we go. Their cash flow from operations continues to increase and climb. It's doing great. And this is one of the best performing REITs in my portfolio. Although you're going to see from the graph, they do have some volatility. So I've had to hold on a few times and sweat it out a little bit, but it's been fine. So as you can see, during the 2008 crash, this one's been around for a long time. So this one's been around since 97. So you can see when the crash happened in real estate, this thing plunged, right? But since then, it's been doing fine. It's a little bit more volatile, I will say, than some of the other REITs we're going to look at today. But lo and behold, if we go to the summary page, EPR, you're getting in about $78 a share, about almost a 6% dividend yield, which is not bad. And what's nice is you're paid every month. Every month you get a dividend in your account. And over the past 5-year average, about 7% return per year. Average return over 2 years is 6% per year. And year-to-date return is about 24%. And like I said, they're all about entertainment, and that's what you can expect from EPR. Let's go down to the next one because I want to get through these as fast as possible. Medical Properties Trust. Now, this is a REIT I acquired in 2019, and I've been really happy with them so far. Medical Properties Trust is all about holding real estate for medical facilities and things like that. And so basically it says MPT has carved a unique niche in the largest and fastest growing segment of the U.S. economy. Unlike other real estate investment trusts, even those categorized as healthcare REITs, MPT focuses exclusively on providing capital to acute care facilities of all kinds. Through long-term triple net leases and unlike other resources of capital, MPT provides 100% financing to reduce an organization's overall cost of capital by unlocking the value of its real estate assets. So basically, they're all about medical properties and things like hospitals, medical facilities, things like that. That's what they own. And you can go to their website to read more. But I've been really impressed with their performance so far. And they're fairly new. They're a fairly small REIT, but they're growing, and they're growing fairly fast. So top line revenue continues to increase. How's their net income? Net income has really taken off. I don't expect their net income from this year to last year to increase that much. But as you can see, they're doing something right because their operations are growing rather quickly and they're making a lot of money. Down to cash flow from operating activities, same thing. I see positive cash flow coming in every year. That's what I want to see. How's their graph? It's a bit more volatile than the other REITs we're looking at, but in 2019, now I got in January. Let's see, where's January? January's right here. But so I timed this thing pretty right. But in 2019, it's gone up quite a bit, but this is their long-term graph. And of course, like most REITs, if you see back in 2008, if we have another crash like that, this is what you can expect to happen. But still, it doesn't mean your dividend's going to stop. And speaking of dividends, what do they have? Well, Medical Properties Trust is about $19 a share, about 5.5% dividend. They pay quarterly, and you can see right here the average annual returns about 7% per year from a capital appreciation perspective. 22% over the past 2 years, and they're up 20% year to date in 2019. And like I said, mainly they own hospital facilities. And let's go on to NHI, our national healthcare investors, or I should say national health investors. It says, at NHI, we invest in relationships, not just properties. Coming from an operational perspective, we have a deep understanding of the business and focus on providing our operating partners with personalized attention and customized financing solutions. And so it says with our portfolio, skipping over here, with over 200 senior living facilities across the country, our diverse portfolio of properties spans the healthcare spectrum from independent and assisted living facilities, specialty hospitals. We are very proud of our high quality assets and outstanding operators who run them. It says, for the investors, it says National Health Investors is a real estate investment trust specializing in senior housing. We take a disciplined approach to value creation, focusing on staying low levered, I think they mean leveraged, staggering long-term debt maturities, and selectively growing with high-quality operators. So as you can see, their gross profit continues to increase. Coming down to their net income, not as good as I would hoped, but it's still growing. It's still remaining roughly the same. Cash flow from operations, though, that's looking healthy. It's looking strong. It continues to bring in more cash every year. And the chart. Let's look at the chart. Well, as you can see, it's performed pretty well. And for what it is, so for senior living facilities, which, if you ask me, that's the demand for that. It's only going to continue to increase because we're going to have more people retiring and needing those healthcare needs in the future more than ever before as the baby boomers continue to retire. And if we go to the summary page, you can get in National Health Investors for about $83 a share. You're looking at about a 5% yield, which is paid quarterly. And the returns haven't been the best for this in terms of capital appreciation, but you're averaging about 6% per year over the past 5 years. 2-year return average is really low, only about 2%, and year-to-date return has been 11%. So not doing too bad, not the best, but not too bad. So let's go on to one of my favorite ones now, Realty Trust. Now this is Realty Trust is probably one of the most popular REITs in the markets today, and you're about to see why. So they've been around, I think, for like 26 years. 26 years. And if I go to their page, you're going to recognize what properties they hold, as we're going to look at that in just a second. So monthly dividend strong shareholder returns. So 16.4% compounded average annual total return since 1994. 589 dividends consistently paid monthly. So dividends are paid monthly. 4.6% compounded average dividend growth since 1994. So every year, what they're saying is they're growing their dividend payout by 4.6%. Not bad. Consecutive quarterly increases. They've had 87 quarterly increases to their dividend. They own 59 plus 100 properties. And let's just go over here on the side here. I found this on their website to show you what they own. See those Walgreens you drive by? They own them. They own a lot of them. They have 215 leases on those. Our people are leasing from them the real estate that Walgreens is establishing. FedEx, Dollar Generals. They have 604 Dollar Generals. Pretty impressive. Fitness, Dollar Tree, Regal Cinemas, theaters, Walmart. They own 53 Walmarts, Lifetime Fitness. I mean, there's a whole bunch of properties they own, and even down here they even have Home Depot, which I would have thought that, but they even own Home Depot type of properties. So if you ask me, their portfolio is very diversified, and I really like the properties they own. So look at this top line revenue continues to grow every single year. Let me zoom in on that. Sorry guys, I know it's probably hard to read. Let me come back over here. Here we go. So gross profit continues to climb every single year, which is fantastic. If I go down to their net income, look at their net income continues to climb every single year, and hopefully that trend will continue into the future. And of course, with solid net income, we can see their cash from operations is increasing every year. If I go down to the chart, solid graph. Now, I can't tell, it's hard to see, but this says 1994. This is where the graph cuts off, but they've been around, like I said, for I think 25, 26 years. And if you've owned this investment, you've done really well. I mean, if you've held it since then, or even more recently, you've done great. Let's look at the summary page now. You can participate in this at $75 or about $76 a share. I got in around 69 or 70 is where I bought in because I just recently purchased this. Dividend yield's about 3.6%, paid monthly. Average return per year over the past 5 years has been about 13%. 2-year return average is 14, and then year to date, it's about 20% rate of return. And they mainly own commercial real estate. Commercial holdings is what they have. Okay, 2 more, and then we're going to wrap it up. Thanks for being patient with me. I'm trying to get through this as fast as possible for you guys. Omega Healthcare Investors, all right? This is another healthcare-related REIT. Senior housing is what they're all about. So let me click on the tab here. Let me scroll to the top. And let's see, it says, investing in senior care since 1992. It says, Omega Healthcare Investors is a triple net equity REIT that supports the goals of skilled nursing facility and SNF. I'm getting my tongue all twisted here, guys. Tongue's getting twisted.
Do you speak any English? Do you understand the words that are coming out of my mouth?
An assisted living facility, ALF, operators with financing and capital. We are partners with over 65 of the most future-focused, whatever that means, growth-oriented operators in the US and UK, accelerating their growth strategies with $1.25 billion unsecured credit facility and proven access to the largest public equity and debt markets in the world. So they're all about helping finance these healthcare facilities so that people can operate and these people can get the care they need and so on and so forth. The way I see it, I don't know about what you guys' thoughts are on this, but I think that, like I said, there's definitely a need more and more for either assisted care or like an assisted living facility or like a senior care facility as more and more people retire and face all kinds of healthcare needs. So income. Okay, once again, this actually doesn't have consistent top-line revenue growth. However, I think they're on track for it again, in terms of their gross profits. Let me go down here. Net income. All right, their net income is a little bit sporadic. It is. They haven't lost any money, but their income isn't as consistent as some of the other properties we looked at or some of the other REITs we looked at. Cash flow from operations, though, the cash is just like their net income was a little volatile, so is their cash from operations. But overall, guys, I'm not seeing any losses here. They're still making a lot of money. It's just not as consistent as some of the other REITs we've already looked at. Right now, they have a downward trend. Okay, the long-term trend is down. However, in the short run, if they can break through this barrier, this ceiling, then I think they have a chance to start increasing in value once again. And I wouldn't expect their technicals or their charts to look as hot. And the reason why is, let's come to the summary page here. Now, they're about $41.50 per share. And the reason I wouldn't expect as much capital appreciation as these other ones is look at their yield. They're paying out more of their earnings to their shareholders and investing less back into the operations. Okay, so that's why I don't think we're seeing as strong as, from a growth perspective, in terms of a capital appreciation perspective, I don't think we're getting that because of this higher yield. So you have to take all these factors into consideration when you're looking at these. The returns over the past 5 years haven't been the greatest. However, in the past 2 years, that's when they've started to turn around their investments. And year to date is 18%, which is not bad. Okay, the last one, Ventas Inc. Let's look at that real quick. And that deals with medical offices. VTR is the ticker symbol for this investment. And it talks about our diversified healthcare portfolio. With approximately 1,200 properties in our carefully created portfolio, we foster strategic partnerships with leading care providers and premier innovative health care and research institutions throughout the United States, Canada, and United Kingdom. So you're going to see they have some senior housing, they own some medical offices, they own some research facilities, and they own health systems, which is investing in leading healthcare providers through real estate ownership, enabling them to expand their competencies, extend their brands, and enhance their ability to address the total cost of care. Okay, so basically they're helping the medical sector in various facets is what they're doing. And if we come down here, they've had pretty consistent revenue growth from the top line, which I like to see that. And their net income is, they made a lot last year. Not as much in 18, but, they made a lot in 17, but not as much as 18. But still, very profitable. To me, they're still doing fine overall. And cash flow from operations, to me, it's looking pretty good. It's pretty consistent. The numbers are pretty close year by year. And if we come over to the summary page, if you look at the price per share, it's about $75 per share. Yield's about 4.25%. Pays quarterly. And like I said, medical office is what they're all about. It's 5-year return. It hasn't done well the past 5 years, but just recently it started to pick up steam here. And you're going to see a 4% return average over the last 2 years. And this year, 26% rate of return year to date, which is not bad. Okay, so I just went over these real fast for you guys, real fast. And I know that's a lot of information, but these are the 7 real estate investment trusts or REITs that I own in my portfolio, and I'm going to continue to add more to my portfolio over time. And just a couple of things I learned is that REITs are, because of their higher yield than a normal stock, because they're required to pay out 90% of its earnings to their shareholders, you're going to find more volatility in terms of the underlying investment. So expect that. Now, when I started, like I said, the first investment I chose was EPR, and because I understood the business, I read it, I liked the kind of properties they own, and to me it made sense. And so I've owned the most in this one, in EPR, and probably more than I want to, but when I first started, I didn't know what the heck I was doing. I mean, honestly, that was probably like 4 or 5 years ago. This was the first REIT I ever bought. But I've learned now to be a little bit more selective on my REITs and be careful about what I'm buying, and I'm trying to diversify my portfolio of REITs. So I have mainly entertainment properties and commercial and healthcare facilities now. The next REIT I own is going to cover a different sector of real estate. So one of the ones I'm looking at next is one that holds cell phone towers or leases out cell phone towers, which sounds really interesting. So I'm looking at that one and a few other ones. Now, I chose individual stocks because that's the kind of investor I am. I do have ETFs in my portfolio, but not for REITs. And I did that because what I would do, and it's kind of a cheater's way to do it, but I would look at a REIT such as, let's say, like Vanguard's real estate index fund, like VNQ. So if you've never checked it out, check out VNQ. And that, by going into the holdings of Vanguard, I could see many of the REITs that I currently own on their list. And so I could then selectively pick which stocks I wanted to own, okay, in terms of the REITs. And that's just kind of how I like to invest, because I get a much higher yield that way. And if these stocks perform well, I'm going to probably get a higher return with no fees, which is nice. So that's why I like investing in individual stocks. But if you don't want to play the whole stock game, you can just buy an index fund like VNQ, and it's doing great. I mean, VNQ is up 20% or more this year alone, and you get a lot of diversification just within that one ETF. But it really depends on your style of investing, how much research you want to do, or how involved you want to be. Totally up to you. I don't care which way you guys do it. But I think REITs are great for income, and I think they're going to become a more and more popular investment as time goes on. I just built this portfolio just of REITs, just one at a time. I only invested about $1,000 or $2,000 at a time into these REITs when I got started. I would watch how they did over the next 3 or 4 months, and if they did well, I'd invest more. And on some of them, like EPR, this one, it pulled back quite a bit several times. So for a couple of years, I had actually a negative return on this investment. But I held it, and I actually added more to my position when it was lower, and it came back. And so now I'm doing very well. So every single REIT on my list, I have a positive total return right now. Positive. And the other thing you should know is you got to think of total return. Now, this averages I acquired from Yahoo Finance. This is where I got this data from, just from looking over at Yahoo. But you got to remember, your total return is the capital appreciation portion plus your dividend. And so this bottom line here on the spreadsheet is the averages, okay? So of the real estate investment trust I own in my portfolio, the average dividend yield is about 4.8%, 4.86% of all of these, right? And the average 5-year return is about 7.93%. So if you take 7.93, which just comes from capital appreciation and share price growth, and you add the dividend yield, you're now at a 12.79% return average, total return. So on average, in my portfolio here, these are going up by 12% per year. Some years more, some years less. But on average, that's where I've come out so far. And yeah, I'm excited about investing more in these things as time goes on, and really building a solid income for myself, building it for my future retirement, and being able to participate in real estate without the headaches of property management, without trying to secure a mortgage and all that stuff. I really like investing this way. It's really simple to do, and I can add more money to it every month. All right, guys, well, that is the video today. That's a lot of information, but hopefully you found this helpful. Download the spreadsheet for yourself, and you can review this in more detail. If you have certain REITs that you really enjoy investing in, please share those below. Tell me why you invested in them and why it's working out for you. I would love to hear what other REITs are out there. There's so many. There's several hundred real estate investment trusts to choose from in the market. I always start with the financials of the company first to see how they're doing, to see if they're making money and bringing in more money every year. And then I look at the technicals next. That's what I look at. And by doing so, it's worked out pretty well. And so right now, I'm currently making about $100 a month. If you average out the monthly dividends and the quarterly dividends, it's about $100 a month just from REITs alone, excluding all of my other investments. All right, guys, if you liked today's video, make sure you drop a like before you leave, comment below, subscribe to our channel to not miss any of our future videos, as we're going to have more on this as we make new videos every week around finances, investing, taxes, and more. So make sure you hit that red subscribe button and bell notification icon below. With that being said, thank you for watching and spending time with me here today in YouTube. I'll see you in the comments. Live life uncaged, and I'll see you in the next video. Peace.